Bradley, would you do the honors?
Today's session of the Secret Millionaires Club is hereby called to order.
It is so cool when that happens.
What's cool? What did I miss?
Only the initiation of the meeting. We have yet to report the minutes of our previous meeting, for which I have copious notes.
Sorry, Noteboy, but we have a serious financial emergency.
Oh, well, for that, I guess we can skip the minutes.
But very well. Elena, can you debrief us as to the particulars of the alleged emergency?
Okay, my friend Brittany has this lemonade stand, and she's trying to raise $102 so she can go on the class trip.
That's very enterprising of her.
The problem is nobody's buying her lemonade. And she has to have the money in 24 hours.
I love a good mystery. Let's see what clues we can dig up.
Okay, maybe her lemonade is made with rotten lemons.
Nope, her lemonade is top grade.
Quality? Check.
I get it. I bet there are like 16 other lemonade stands on her block.
And oh, she's got a hopscotch on the whole block.
Hopscotch? Don't you mean Monopoly?
I knew it was some game.
So, translating Elena's speak, zero competition. Check.
Then it can only be one thing. She's charging too much for a cold glass of lemonade.
It's icy, but not pricey.
Hey, my ball!
Satisfactory price point? Check.
So, secret millionaires, what essential element for a successful retail business is missing?
Oh, I got it. There is no market for lemonade.
That's not a bad theory, Jones. But I know I really enjoy a nice cold lemonade from time to time, and I'm sure I'm not the only one.
As a matter of fact, according to my data, soft drink sales are usually maximized during the warmer months.
I give up. It's a total mystery. I'll never find that ball.
Can't find it? Can't find it. That's it! Look, Brittany lives on a totally quiet street. No one can find her.
I think you've solved the mystery, Elena. In order to establish a healthy customer base, a retail business has to have a good location. Who do you think gets more business? A store on a side street or a store on Main Street?
I would venture to say Main Street, of course.
So, we gotta help her find a better place to sell her stuff.
We'll have to initiate a comprehensive research project.
That won't work, Einstein. It'll take too much time.
I got time. Soccer practice was rained out.
Wait a minute. Soccer Brat just gave me an idea for a super location.
I did? Oh, yeah. I did that on purpose.
Now that you kids set up Brittany's lemonade stand at the soccer field, she's doing so well she made the deadline with time to spare.
Okay, now where's Jones with our lemonade?
I think we may have to postpone imbibing the lemonade. Jones' coordinates seem to be the incorrect location.
Yeah, the end of the line.
Remember, if the people won't come to your business, bring your business to the people.
And now, here's words from Warren.
Hey kids, Warren Buffett here. Just like a retail business needs a good location to attract customers to its store, you need to think of location too. When you're in a classroom, it's best to sit in a place where you can listen to the teacher. The better you are located and able to pay attention, the better you will do in school. So remember, location, location, location. Pay attention and listen to learn the most you can. The best investment you can make is an investment in yourself. The more you learn, the more you'll earn.
Do your managers love finance? Do your managers use finance as part of their day job, such as managing departmental budgets? Could your managers be more effective if they were awesome at understanding their figures? If your answer to these 3 questions is yes, fresh, fun and energetic financial training is essential to help your managers improve financial performance in their department, boost company profits, contribute more effectively to decision making, challenge and correct business health and performance, transform budget management and forecasting skills, enhance their confidence when dealing with the numbers, avoid being bamboozled by all that financial jargon, and boost overall professional effectiveness.
An asset is something that a company, person, or even entity such as a country owns that is expected to generate future economic benefits. For a company, machinery represents a good example. For a person, a home that was bought without a loan can be considered a decent asset, whereas even countries themselves possess assets like, let's say, land. Liabilities, on the other hand, represent a future obligation of paying money, providing a service, and so on. To put it differently, assets are expected to generate resources, whereas liabilities will drain resources. But what if Joe takes out a mortgage to buy a home? Is he adding an asset or a liability to his life? Well, both. On the one hand, his home can generate future economic benefits by going up in value, producing rent income, etc. On the other hand, though, Joe has to keep making his monthly payments, so until the mortgage has been paid off, the liability dimension is here to stay. At the end of the day, whether we're talking about companies, individuals, or countries, trying to add assets and get rid of liabilities should be one of the top wealth management principles to live by.
Liabilities are used in business. You can use that knowledge to your benefit in your personal life as well. In accounting, assets and liabilities are terms that you will find on the balance sheet. What you own is on the left, assets. What you owe is on the right, liabilities and equity. Let's work through some examples of assets and liabilities. What about a machine the company bought to produce goods that it is selling? This is a tangible fixed asset, something that the company owns and that has physical form. Let's place that in assets on the left. What about accounts receivable? These are invoices sent to the customer, which the customer has not paid yet. This is an asset as well. We own the right to collect the money for the goods or services we have delivered. What about accounts payable? These are invoices received from a supplier, which the company has not paid yet. This is a liability. We owe money to the supplier. Let's place that on the right. Cash. Cash is a financial asset. Cash is very liquid. In most cases, you can use it immediately to pay your obligations. Inventory. Inventory is an asset as well. These are goods that we own and intend to sell. A loan agreement, a borrowing debt. The company owes money to the bank. This is a liability. We now have many of the elements of a balance sheet for a company. There is one more very important element which fits in the bottom right corner of the balance sheet. Equity. Equity is the shareholder capital. You can calculate it by taking the total value of the assets minus the total value of the liabilities. Now that you understand the picture of assets, liabilities and equity on the balance sheet, let's think of the dynamics going on in a company. A company will try to generate a return on assets. If the revenues generated from selling goods and services are bigger than the expenses, such as labor, materials and depreciation of manufacturing equipment, then the company generates a profit. Return on assets relates the amount of profit made to the assets needed to generate that profit. Some companies need very few assets to generate a substantial profit. Other companies may need a lot of assets to generate only a modest profit. Increasing ROA is generally a good thing. On the liability side, having debt generates a cost of borrowing. The amount of interest that the company pays depends on the amount borrowed and the interest rate. If a company improves its financial health, its cost of borrowing tends to go down. In general, it is good to have a return on assets that far exceeds the cost of borrowing. Let's apply what we learned about assets and liabilities to assets and liabilities in your personal life. What if you own a house? That's an asset. However, if you rent a house as a tenant, then you wouldn't put the house on your balance sheet as an asset, as you don't own it. What if you own a car? That is an asset as well. If you lease a car, you wouldn't put the car on your balance sheet as an asset, as you don't own it. What about cash? That is an asset. Unpaid credit card bills, a liability. A portfolio of stocks, an asset. A loan agreement with a bank, for example the mortgage loan on your house, a liability. There is one more element which fits in the bottom right corner of the balance sheet, equity. You can calculate it by taking the total value of the assets minus the total value of the liabilities. Within the assets in your personal life, there can be items that we call potential earning assets. Cash in a savings account that pays you interest, and stocks in an investment portfolio that pay a dividend or go up or down in value. Just like companies monitor their cost of borrowing closely, you should also keep track of your cost of borrowing on various types of debt you might have outstanding. Chances are that the unpaid credit card bills carry the highest interest rate and therefore should get the highest priority in paying down. So what is financial wealth in somebody's personal life? A lot of people mistake wealth for assets. We tend to think that the more assets somebody has, the wealthier that person is. But what if that beautiful yacht, as well as that fancy sports car, are all debt financed? Assets increase, the person owns more, but liabilities also increase, the person owes more. The more debt you add, the more fragile you get. The true measure of financial wealth, which is often not visible to the outside world, is the amount of equity that somebody has. Assets minus liabilities. Looking at somebody's assets without knowing how they are financed might be deceiving. It might actually be the person with the smaller house and the older car, but with very few or even no liabilities, that is the more financially wealthy.
The net worth of a person is simple to calculate. All you have to do is subtract the money that person owes from the combined value of all his assets. Let's assume John owns an apartment which is worth $100,000, a car with a current market value of $10,000, and various other random objects, with a combined market value of $5,000. In other words, the combined value of his assets is $115,000. Now, let's look at his debt level and assume the only debt he has is $15,000 that he owes to his brother. After drawing the line, he has $115,000 in assets and $15,000 in debt. After subtracting the $15,000 debt from the $115,000 value of his assets, we're left with his net worth, $100,000. It's important to understand that a person's net worth fluctuates. Maybe a year from now, he paid off $5,000 of his debt to his brother, leaving him with only $10,000 in debt. On the asset front, we'll assume his apartment is still worth $100,000. That his random objects are still worth $5,000, but that the market value of his car dropped to $7,000. In other words, he now has $112,000 in assets and $10,000 in debt. So, a net worth of $102,000. It's ridiculously easy to determine a person's net worth. When's the last time you calculated yours? As mentioned in an earlier video, you can calculate your net worth by subtracting your liabilities from your assets. Now, as far as the assets are concerned, it's important to understand that their value can and most likely will fluctuate. Of course, nobody can predict the future, but there are assets about which you can be pretty much 100% certain they will go down in value. Cars, tablets, computers, and even furniture are called depreciating assets for the simple reason that their market value goes down as time passes. Maybe because they have a limited lifespan, with electronics being a good example. Perhaps due to wear and tear like with furniture, you surely get the point. Some assets lose value quickly. For example, the value of a new car will plummet the minute you leave the dealership with it. The value loss isn't as brutal with other depreciating assets that are more durable, but it still occurs. What you need to understand is this. You buy depreciating assets, you certainly don't invest in them. You invest in assets when you acquire them with the expectation that they'll go up in value. You invest in real estate, stocks, precious metals, and so on. You buy everything else. Maybe because you need to, perhaps because you want to. There's nothing wrong with this as long as you understand that not all assets are created equal. Do your best to limit the amount you spend on depreciating assets and try to accumulate investment-grade assets that are likely to be worth more in the future.
As an ultra-simplified example, we'll assume Joe has a web design business that sells simple websites at exactly $100 each and currently has 3 employees who are paid a fixed monthly salary. To run his business, there are costs involved, with the 2 main dimensions being A. Fixed costs, or costs that stay the same no matter how much business you do, so whether he had 0 clients last month or was super busy, the fixed costs stay the same. In his case, these costs are 1. The rent he pays for his office, 2, the salaries he pays his employees since they are fixed. 3, the monthly license fees he pays for the various software his company uses. B, variable costs, or costs that fluctuate. In his case, 1, utilities such as the electricity bill, which go down if there are no orders and nobody has to come to the office, or up as people stay at the office more, consuming electricity when working. 2, overtime pay, if he has lots of orders and needs his employees to work more than they agreed to in exchange for their fixed salary. It's worth noting that had Joe chosen to pay people on a per hour rather than fixed basis, all employee pay related costs would be variable. After drawing the line, Joe calculates the total costs by adding up the total fixed costs and the total variable costs. Finally, the marginal cost of production is the cost it takes to create one more website. If there are no overtime costs involved, the marginal cost of production is quite low, with only slightly more electricity being required to create an additional website. During a busy month which requires overtime pay, however, the marginal cost goes up. Tom runs a one-man business which revolves around him building wooden swords that he sells at $10 each. Last year, he sold 10,000 swords, generating a grand total of $100,000. We call this amount his revenue. Unfortunately for him, he doesn't just keep the entire amount. First of all, there are direct costs involved in making the swords. These are called COGS, as in cost of goods sold. In his case, we'll say they amount to $4 per sword that he spends on materials. If he had employees, there would be direct labor costs as well. After subtracting the $40,000 cost of goods sold from the $100,000 revenue, we are left with a so-called $60,000 gross income, also referred to as gross profit or gross earnings. Once again, however, he doesn't keep this amount either because there are more than just direct costs involved. Tom's business also has expenses such as rent and taxes need to be paid. Let's say his expenses including rent amount to $25,000 yearly, whereas taxes amount to $20,000 per year. After subtracting the $25,000 expenses and $20,000 for taxes, we are only left with $15,000, called the net income, net profit, or net earnings. Since this amount is usually found on the last line of the income statement of a company, it's also referred to as the bottom line. Broadly speaking, that's pretty much it.
Working capital management, or how companies can successfully leverage hidden liquidity reserves. How does it work?
Let's imagine you operate a buy, stock, sell business in children's toys. You buy from your supplier, hold the toys in stock, and then sell to customers. Sometimes the product moves through your business at a nice steady pace. Sometimes the process has a bit more variability and the pace is a little slower. What would you prefer as a business owner, assuming the pricing and profit margins are the same between the two scenarios? Would you vote for option A, where you pay your supplier cash on delivery, hold high inventory levels, and grant customers 45 days credit before they need to pay you? Or would you vote for option B, where you have 45 days credit from your supplier, work with just-in-time inventory levels, and have your customers pay cash on delivery? Please think about that and vote. With option A, there is a high working capital that somehow needs to be financed by debt or equity. With option B, there is a low working capital, reducing the need for financing. With option A, cash flow and return on assets will be lower. With option B, cash flow and return on assets will be higher. The definition of working capital that we use in this video is the total amount of capital invested into your company's operating cycle, day-to-day operations. I believe this is the most useful way of looking at working capital. What is the relationship between working capital and cash? Let's say that your children's toys company decides on 3 actions: paying suppliers quicker than before, holding more inventory, and granting customers extended terms. This drives working capital up and cash down, possibly triggering the need to go out for more financing. If, however, you stretch supplier terms, pay them later, achieve higher inventory turns, and improve the collections of payments from customers, your working capital would decrease, and as a result your cash would increase, possibly increasing the opportunity to pay down loans or pay dividends. Two examples of how to calculate working capital for real-life companies. First, 3M's balance sheet at the end of December 2018. I would say their working capital consists of the sum of accounts receivable, inventories and accounts payable. Although you could argue that items such as prepaid expenses on the asset side and accrued payroll on the liability side may also be considered in scope. $5 billion in accounts receivable plus 4.4 in inventories minus 2.3 in accounts payable equals a net working capital of $7.1 billion at the end of December 2018. Microsoft at the end of their fiscal year 2018, which is June 2018. Same items like at 3M. Accounts receivable, inventories, minus accounts payable. On top of that, due to the nature of the business, there is another significant amount in liabilities called unearned revenue or deferred revenue that would normally be included in the working capital calculation. This is revenue for which Microsoft has been paid in advance, which is yet to be recognized over the multi-year agreement, in other words, a liability to customers for future services. This has a big impact on the net working capital balance, which for Microsoft is actually a negative number of $12.1 billion. A negative working capital balance is actually a good thing. Both suppliers and customers are financing your day-to-day operations. In summary, working capital is the total amount of capital invested into your company's operating cycle, day-to-day operations. Manage working capital well to improve your company's cash flow and increase the return on assets. What's important about money in the context of spending money, saving money or investing money? First of all, how much are we talking about? Second, money when? We need to know both the amount as well as the timing of the money. To explain that second item, timing of the money, let's search for equivalent amounts of money in time. Would you prefer $100 today or $100 1 year from now? I'm pretty certain you would say $100 today. Why wait? What about the choice between $100 today or $101 next year? I would guess that you would still prefer the $100 today. 1 year from now, the prices of goods or services that you want to spend the money on could have gone up. That's called inflation. Inflation could tear up that extra dollar, or even more than just $1. You might be worse off. Plus, let's admit it, you probably don't have the impulse control of having to wait a whole year for just one additional dollar. Better take the $100 right now. How about $100 today or $110 next year? I'm pretty certain you would take the $110 1 year from now, as that sounds far more attractive. Okay, somewhere in between then. How about the choice of $100 today or $105 1 year from now? Maybe you will say, I'm fine either way. If that's the case, then we have just found the equivalent amounts in time and identified the time value of money for you. The time value that we found for you in this example is that $100 today equals $105 in 1 year. $100 is the present value of $105 1 year from now. $105 is the future value 1 year from now of $100 today. Now I'm going mathematical on you. $105 equals $100 times 1 plus 5% to the power 1. The future value equals the present value times 1 plus the rate of return to the power of the number of years. The present value equals the future value divided by 1 plus the rate of return to the power of the number of years. That might be a big abstract mathematical leap. Let's review it with an example. The future value equals the present value times 1 plus the rate of return to the power of the number of years. Let's expand our example to 2 years. $100 today multiplied by 1.05 is $105 1 year from now. That same $105 1 year from now multiplied once more by 1.05 is $110.25 in 2 years. Or if you want to go straight from today to the future value to 2 years from now, $100 today times 1.05 times 1.05 equals $110.25 2 years from now. 1.05 times 1.05 is the same as 1.05 squared, which is the same as 1.1025. We can also work in the opposite direction. The present value equals the future value divided by 1 plus the rate of return to the power of the number of years. $110.25 2 years from now divided by 1.05 is $105 1 year from now. That same $105 1 year from now divided once again by 1.05 equates to $100 present value today. Or if you want to go straight from 2 years from now to today, $110.25 divided by 1.05 times 1.05 equals $100 today. 1.05 times 1.05 is the same as 1.05 squared, which is the same as 1.1025. Time value of money is the idea that money that is available at the present time is worth more than the same amount in the future. With the rate of return, you can convert from present value to future value and the other way around. Time value of money is also the underlying principle for concepts such as net present value and internal rate of return.
To determine whether you should, for example, invest in a company or buy its corporate bonds, you can analyze its financial statements. There are 3 important financial statements which complement each other. 1. The balance sheet, which is kind of like a photo of a company at a certain point in time. It tells you at that point in time what assets such as cash in the bank, inventory, or real estate that company has, and what liabilities it has, such as, for example, debt to suppliers. Subtract the liabilities from the assets, and you'll have the net worth of the company at that point in time, also called equity. 2. The income statement, also called the profit and loss statement, does exactly what its name suggests. It gives you a summary of the revenue and expenses generated by a company over the reporting period. 3. The cash flow statement also has an intuitive name and tells us how much actual cash and cash equivalents entered and left the company over the reporting period. If, for example, the management reports considerably higher profits, but there hasn't been that much of a net cash flow increase, you as an investor have valid reasons to be a bit skeptical. So, as a short recap, the balance sheet helps you determine the net worth of a company. The income statement shows you how profitable it is, and the cash flow statements tells you things such as whether or not the profit numbers are believable.
Finance idea number 1. Profit is not necessarily the same as cash flow. Let's say you are full of ideas. You like to invent stuff. You have come up with a breakthrough product and got a prototype working. However, your personal strength is really in inventing, not in manufacturing nor in selling. So you get somebody else to do the manufacturing of your product for you. They produce the goods according to your specifications, ship them to you, and you pay cash on delivery. You also get somebody else for the selling of the product to consumers. You ship the goods to a retailer, but instead of the retailer paying you immediately, you will receive payment after 30 days. This month, you buy 100 units at $80 each and sell 50 units at $100 each. The other 50 units stay in inventory. How much profit do you make? You deliver and sell 50 units at $100 each, so your revenue is $5,000. The cost to you of sourcing those 50 units that you have now sold is 50 units at $80 each, so your cost of goods sold is $4,000. In short, you sell 50 units at $20 margin per unit, so generate a profit of $1,000. How much cash flow do you generate? Well, you don't get paid by the retailer until 1 month from now, so cash in is zero. You paid your supplier on delivery, so cash out is $8,000. Total cash flow is negative $8,000. Profit on your shipment is recognized when you deliver the goods to your customer, the retailer. Cash flow is recognized when cash comes in or cash flows out. You could be profitable yet go bankrupt. Finance idea number 2. Each financial statement tells a story. The balance sheet gives you an overview of assets, liabilities, and equity. It shows what we own on the left and what we owe on the right. The income statement shows you how revenue minus expenses equals profit or loss, or in other words, how sales minus costs equals income or loss. The cash flow statement shows you how you got from the cash balance at the start of the year through cash inflows and cash outflows during the year to the cash balance at the end of the year. A balance sheet is a picture at a point in time, usually the end of the month, end of the quarter, or end of the year. An income statement is a movie of profitability during a month, quarter, or year. A cash flow statement is a documentary movie about movements in the most fascinating account on the balance sheet, cash. Finance idea number 3. Book value, what a company is worth on paper based on the balance sheet, is not necessarily the same as market value, what someone is willing to pay for it. Let's look at Apple Inc. The book value of its equity on the balance sheet of March 30, 2019 is around $106 billion. The number of outstanding shares, 4.7 billion units, so the book value per share is around $22.55. If you look at the market value of the share price in early May 2019, you see the share price around $200. Book value or accounting value is based on the company's historical financial results looking back. Market value or economic value depends on the expectations of investors for the future of the company looking forward. Finance idea number 4. There are many ways to drive operating income. If you listen to CEOs and CFOs, it sometimes seems that the only thing they can think of is cost cutting, and more cost cutting. While that could certainly be an appropriate way forward, there are more options to choose from. Price. Are you charging a price to your customers for your goods and services that accurately reflects the value you are creating for them? Volume. What opportunities do you have to sell more units? Mix. Can you focus more resources on selling the higher margin products and services in your portfolio versus the lower margin ones? Productivity. Can you generate the same amount of output with fewer resources or more output with the same amount of resources? Sourcing benefits. Can you renegotiate your contract with your existing suppliers to get lower price or more value? Or can you find alternative suppliers that give you a better deal? Spending more. Can you spend more on research and development to develop your product or service faster and better and generate more revenue and margin? Can you spend more on marketing to establish your brand? Can you spend more on learning and development to improve the skills of your employees? Let's start with the common factor in these financial metrics: ROIC, ROE, ROA, ROI. Do you see any similarities? Yep, they all start with RO, which means return on, which is then followed by one or more letters of the alphabet. Each of these financial metrics is trying to help you understand how much bang for the buck you get. In more financial terms, how much value for money you get. For all of these financial metrics, ROIC, ROE, ROA, ROI, the higher the better, assuming the returns are sustainable and not a one-off. That's because the formula, the calculation of the financial metrics, is very similar. Put the bang in the numerator and put the buck in the denominator. In other words, put the outputs or benefits or returns per year in the numerator and the inputs or investment or a capital in the denominator. If I invest $1, how much annual return is being generated on that investment? Let's look at the formula more specifically for each of the four common financial metrics. ROIC, return on invested capital, is calculated as the sum of after-tax interest expense plus net income divided by the sum of debt plus equity. ROE, return on equity, is calculated as net income divided by equity. ROA, return on assets, is calculated as net income divided by assets. ROI, return on investment, is calculated as benefits or returns divided by investment. Let's make some meaningful comparisons on a one-to-one basis between these financial metrics. In the blue corner, ROIC, in the red corner, ROE. What is the difference between return on invested capital and return on equity? In my view, this is the broader perspective of ROIC, focusing on the returns for both bondholders and shareholders, in other words, debt and equity or invested capital, versus a narrower perspective of ROE, focusing specifically on the returns for shareholders. In the blue corner, ROA, in the red corner, ROE. The similarity between return on assets and return on equity is that both financial metrics have net income in the numerator. The difference between ROA and ROE is in the denominator, assets versus equity. Let's look at the balance sheet. Assets is the sum of what a company owns. Bottom left of the balance sheet. Equity is the book value of the shareholder capital, a subset of what a company owes on the right-hand side of the balance sheet. As liabilities are by definition greater than or equal to zero, and in actuality for most companies a sizable number, equity should be a lower number than assets. Therefore, if the denominator number is lower, then return on equity should be higher than return on assets. ROA and ROE are related metrics in the DuPont formula. ROE equals ROA times leverage. In the blue corner, ROA, in the red corner, ROI. Return on assets and return on investment are similar, but I would use them in very different situations. I use return on assets when analyzing the financial statements of a company in an annual report, while I use return on investment when analyzing a specific investment like a machine or a piece of software, or the expected return on bonds or stocks. An example of ROI: when buying a new machine for $100,000, how much incremental margin will the product produced on that machine generate for the company? In the blue corner, ROE, in the red corner, ROI. These can both be used on the project or deal level. Return on equity for the expected or actual benefits purely for the shareholder in the project or deal. Return on investment for the overall benefits of the project, regardless of its financing structure. As borrowing money through debt tends to be at a lower cost than the desired returns by shareholders, ROE on a project or deal is usually higher than ROI. In summary, ROIC, ROE, ROA, and ROI are similar metrics, helping you to analyze whether an investment brings value for money. You can choose which financial metric to use for a specific situation. Each metric has a situation where it provides the most relevant perspective. Remember, financial analysis is as much an art as it is a science.